This is MacroVoices with hedge fund manager Eric Townsend, the free weekly financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. MacroVoices is all about the brightest minds in the world of finance and macroeconomics telling it like it is, bullish or bearish, no holds barred. Now, here are your hosts, Eric Townsend and Patrick Ceresna.
Let's move on to this week's Postgame chart book, which is titled Squeeze Insanity Part 2, The Aftermath. I want to start on this Gamestop chart. I'm sure you want to have got other stuff that you want to talk about, but I realize here as I look at this, there's an aspect that I forgot to ask Jim Bianco about that I want to touch on, which is part of what happened with GameStop is the reason they knew that it was such a ripe opportunity for a squeeze is because the short interest in GameStop was actually larger than the entire float of GameStop. How is that even possible? Because if the whole idea of short selling is supposedly you borrow shares from somebody who has them and sell them and have to pay them back later, well, wait a minute. How can you borrow more of something than exists for anyone to lend to you? That doesn't seem to make any sense. What's going on here?
Right. So let's talk about this because that's actually a great question. I'm sure a lot of our listeners will benefit from us trying to explain how this happens. But the one thing that is very evident is that naked short selling has been brought to light as the villain. This idea that there's naked short selling going on that has created or contributed to this short interest being greater than the outstanding float. But it really comes down to the fact that you have to look at it more than beyond one dimension. Short selling has many of the same characteristics as fractional reserve lending. The idea is that the same shares can actually be lent and relent multiple times. So let me explain. So let's say we have a company issue 100 shares and investor A buys those shares and puts them in their margin account in brokerage. And that's the outstanding open float. Now, investor B comes along and wants to short sell the stock and then borrows that inventory of the 100 shares and proceeds to sell it into the market through the exchange. When investor C, a new investor, comes along and buys those 100 shares from the short seller, when they buy them, they're not designated as short stock or borrowed stock. When that investor buys them, they're assuming that they're buying the same shares as investor A has, with all of the same privileges and everything like that, and they deposit in a margin account, and that brokerage that received investor C's shares treats them the same as investor A to lend them out again. And so what happens is you can have a brand new short seller come and borrow investor C's shares, even though investor C purchased the shares from short seller B, who borrowed the shares. And so this cycle can repeat itself. And so you can have the short interest actually grow considerably greater than the outstanding float as this cycle can actually perpetuate. So the vast majority of short selling is often passive, though. It's not like everyone's trying to villainize it, and it's done with intentions not to necessarily harm the company. And if there are, of course, cases where that is the case, but actually short selling provides liquidity that greases the wheels of the market. For instance, a lot of times short selling is used by market makers to facilitate hedging or customer purchases, or arbitrageurs that are short selling stock against index futures or ETFs to keep the net asset values in line, or long short funds are using short selling as a way to hedge or reduce their portfolio volatility. Of course, you'll have the Chainoses of the world that are out there to actually try to profit from exposing fraud. But the idea of villainizing broadly short selling, I think, is incorrect. I mean, there are some things that are probably out of balance, and then maybe the SEC has to come in and maybe check whether the rules are right. But overall, I just don't think it's as big of a deal as everyone made it. But that doesn't change the fact that GameStop had this extraordinary squeeze, right, Eric? Like, it was unbelievable, that feedback loop that came in when that kind of golf ball in the garden hose of buy orders came in with margin calls and all sorts of other things that created this extraordinary move. I mean, the stock was like half a year ago, $10 or less a share, and shot up to almost $500. And now that whole thing is kind of blown off, it's reverted right down to about $68 at the time we're recording. But it's been just a crazy move, but it's very likely over at this stage.
Patrick, something that I've noticed in the last couple of days, and this is after we recorded the interview with Jim Bianco, which was recorded on Tuesday morning this week, it seems to me like it really ought to be clear now that, okay, this short squeeze worked. Some people made some money on it. The squeeze is over. Nobody in their right mind, given that GameStop basically is a mall store, that most of its actual stores are in malls that are closed down because of the COVID crisis. This is a company whose fundamentals are awful. Nobody in their right mind should be thinking, oh, well, maybe it went to 500 because it's a great company that has great growth potential and it's going to make a lot of money and it's a good stock to own for the long haul. Nobody anywhere should have ever thought that. This was a squeeze that was perpetrated for the purpose of forcing hedge funds that had concentrated short positions to have to cover, creating a forced buyer that the people who put the squeeze on could sell to if they were really talented at it, right at the top, over $450. The people who perpetrated the squeeze made a killing. The hedge fund lost half of its value. That's where the story pretty much ends. Now you got a stock trading at $450. Anybody in their right mind ought to expect the next thing that should happen, the only reasonable thing to expect to happen, is that it collapses from $450 back down to what it's really worth. But what I've seen in the last couple of days is like Mark Cuban publicly telling people, if you're in GameStop, and you possibly can, you should try to hold it. What? Hold it? Why? It's overvalued by several $1,000% because of a short squeeze that was perpetrated for the purpose of forcing the hand of a hedge fund. That's over and done with. Why is anybody advising anyone? And I really feel for the people who have been suckered into this thing that are being told, okay, keep on holding on to your GameStop shares. Don't panic. It's going to turn around again. Why are they telling them this?
You know what? I guess that's the nature of markets and greed, and the fact that we all come into this market with different perspectives, right? And when you really look at the fact that it was purely a very technical squeeze that happened in terms of just liquidity of shares available and people that needed to cover, I mean, you have to have truly a theme of some sort that there's room to squeeze those shorts again after this extraordinary move. I'm with you. I mean, while I do feel that there's a very good chance of substantial volatility still. I mean, we could have a swing where the stock still goes up 100% and then wipes it out. But it really, at this stage, I think, is over. The likelihood that we see that stock print up in the 400s again is quite unlikely.
Patrick, let's move on to page 3 in the deck, which is silver. As I mentioned earlier, when we interviewed Jim Bianco, everybody was still talking about, here it goes, we're about to squeeze silver up to $1,000 or some ridiculous thing. It was obvious to me and Jim that was a really stupid idea back on Tuesday. Looks like the rest of the market has woken up to it. Is that how you see it, or are we going to see more of this squeeze silver to $1,000 silliness coming out of Wall Street bets?
Well, I think that was really actually, the jury was out for me. Like I really wanted to see what they could do. Obviously, the FOMO of the thought that silver was going to run away without people in perpetuated a strong gap higher toward 30 and created a really big hype and headline news on that Monday break. But really, since then, it's been giving back. But the part that I found to be the biggest tell is that, to me, I was skeptical that silver was going to be able to, in the bigger picture, decouple from gold. And really, one of the themes that I had was that if silver was legitimately breaking out, it should at least create some tailwind behind gold. And that gold was likely to, in some way, benefit. Obviously, silver would very likely outperform on a relative basis in terms of the gold-silver ratio and things like this. But I really thought that we wanted to see gold demonstrate that it was benefiting, and that really wasn't the case. And I think when we go to page 4 and see gold, the one thing we noticed almost immediately on that silver gap is that gold couldn't even get above its 50-day moving average. Out of a almost 1 month consolidation, it couldn't even make a little bit of a higher high during that entire period. And that was a red flag for me. Like, why would gold not benefit in at least some degree from the fact that silver was making that run? And really what we can now see, at least in the gold chart, is that some big players used the spurt of buying to actually sell into. And it really does look like at this stage that some form of another leg lower in gold is underway. Now, like you, I'm actually quite bullish gold in the much bigger picture. But with a breakdown like this below the 200-day moving average, the vulnerability of another $100 to the downside is entirely on the table, maybe heading back at least into the consolidations from April and May of 2020, where we stayed in the mid-1700s in that consolidation. It'll be interesting to see, but like Paul Tudor Jones always says, with the 200-day moving average is like an incredibly important resource for him. It's like the bull market in gold will really be above that 200 days. So with the fact that we're breaking down here, it's going to, at least on the short term, put pressure on gold and maybe create some really good buying opportunities, maybe even a couple weeks or a month from now.
Patrick, let's talk a little bit more about when you know that this is confirmed, because right now we're only seeing the first candle below that 200-day moving average. What really just jumps off the page to me is even though on an absolute price basis we're still slightly above that last low from the end of 2020, that might be true, but in terms of how far below the 200-day moving average and also how decisive the candle that breaks the 200-day moving average is, boy, this really looks to me like it could be the beginning of something, but it is just the first candle. How do you decide? You're the technician here. How do we really decide, okay, the move south is on, and start to make some targets for where it might move from there?
Right. The one thing that I don't like to utilize the 200-day alone as a trading for making my trading decisions, largely because the 200-day moving average is lagging so much behind the price that often much of the market correction can be over by the time the 200-day moving average is even tested. Like go back to March of 2020 during the COVID crash. I mean, really, even though we violated below the 200-day moving average, it was really when gold got down there that it actually was, in the bigger picture, a cheap and a good buying opportunity. So I don't think that this is, in my mind, a sell signal where one would start to begin short operations on gold. But it does mean that the bull market that we were looking for even a week or two ago to potentially come off of the support of these lines has not yet started. And we are in correction mode, and that may last like that for weeks. And so I think that the best takeaway I would give is that I think be patient for a new opportunity to accumulate a new line of gold. I think that you might be getting better prices here in the coming weeks.
Let's move on to the S&P on page 5. The chart here says that we're at 38.51. Just in the time since the chart's been printed, as you and I are talking, we're already at 38.56. I bet we're going to be at a new all-time high by the time our listeners hear this. What do you make of the S&P? Where are we headed from here?
Well, the interesting thing that we pointed out and we continue to point out is that 50-day moving average acted as very strong support. And a lot of technicians watch that 50-day moving average just to kind of identify the primary trend. And the fact that we only had a 4 or 5 day market correction that was just over 100 S&P points, that it was bought within 4 or 5 days and returned back to the highs. This is not the big market correction or sell-off that one would be looking for the start of some kind of big mean reverting correction. So at this stage, the path of least resistance remains upwards. I still believe that the market is overextended, very mature. So many characteristics of a bubble top are there. But the thing is that it's always amazing how long bull runs can last and how far they go before they turn. And so really at this stage, I'm going to be watching whether that new high comes in. If it does, it measures out north of 3,900 toward 4,000. That might be a place where the market will gravitate to in the coming weeks before we see another attempt to begin a correction. So it's definitely on the watch list of things for us to discuss in the coming weeks.
Let's move on to the dollar index on page 6. You can see, looking at the left side of the chart, that, 92 was the level that was support tested 3 or 4 times there during the course of 2020. I'm watching to see whether we can get back up above it. What do you think?
Well, for sure. And there's some technicians that would identify patterns like inverted head and shoulders along the bottom or just basing formations. And often when the dollar being oversold creates a base and then attempts to rally. And the level you're identifying is actually quite relevant. A number of Fibonacci levels lie in that zone as well. That's a support line for the euro as the euro declines toward the 119 level. And so the jury is still out whether this breakout will actually stick as we approach a very critical moment. But this has been an out of consensus trade, and everyone's talking short squeezing of a GameStop and silver, but I think that the U.S. dollar bear is one of the biggest consensus trades out there. And if there was ever room for a liquidity squeeze the other way to get going, is if this thing got north of that 92 plus level you were just talking about. Will it happen? I mean, that's I'm going to be watching all next week on whether that plays out.
Patrick, let's move on to my own favorite topic, crude oil on page 7. We're already back up here to above pre-crisis highs. We've yet to revisit the high from the very first days of 2020, but it looks to me like that's coming next. And frankly, I wonder what comes next after that, but I think it's more up. What do you make of this chart?
Well, I wanted to talk about the dollar and crude oil and including the next chart of inflation expectations sort of in one bigger context, because crude oil, I have there the volume by price levels, which is just showing where there was a huge consolidation of oil in this level in the 55 to 60 plus level was where a very large amount of oil transacted, and it's a fair value price, which often acts as an overhead resistance when something approaches it, price approaches it. And so we have an area where there's room for crude oil to bump its head. I don't want to call it a major turn point or somehow, will mark a major top in oil. But one of the drivers that I view has been driving higher inflation expectations that we're showing on page 8 has been basically weak dollar and rising crude and generally rising commodity prices. And one of the bigger storylines in my mind is, will we see the reflation trade pause? And one of the things that I'll be looking for is that if the dollar was to begin to rally with some momentum and crude oil bumps its head and actually starts to lose some of its upside momentum, it will be really interesting to see if inflation expectations start to back off. And I think that this is a really interesting crossover. At minimum, I don't know how much asymmetry there is in continuing to press crude oil higher. It's also interesting that many energy companies have stopped participating, which is the question is, are these energy stocks going to just catch up with a further breakout in crude, or is crude oil just kind of popping a little bit higher and some of the smart money is using that strength in crude to start unloading some of their broader energy exposure? It's a really interesting thing to watch into over the next couple of weeks.
Patrick, let's move on to page 9, high yield corporate bond ETF.
Right. And so what I really wanted to highlight here is that junk bonds often trade with a correlation to equity. And what we've really seen is that high-yield junk bonds have really held up, while even the investment-grade corporate bonds and obviously treasuries have sold. And this has caused the credit spreads between the junk bond OAS credit spread to narrow to some of the lowest levels we've seen in the last decade. We're trading at 3.68. And really, I find this fascinating because while the Fed has proven that they will provide liquidity to the junk bond market in periods of liquidity crisis, there, I think, is a very important moment coming in the coming year as the coronavirus continues to cause economic havoc. There are going to be a wave of companies that immensely benefit from the changing economy, but also a whole series of companies that get hurt badly by that, particularly brick and mortar companies, and that are going to potentially struggle. And the fact that the junk bonds have not really started to price in default risk at higher levels, I find incredibly confusing. At some stage, I suspect that we're going to see a turn in this, but there's really no sign of it yet. But this is something that I think we have to keep a close eye on, because right now they're acting like there's no risk in seeking the higher returns that come with owning these.
And listeners, you can get a daily update from Patrick with chart books similar to this at bigpicturetrading.com. Information is on page 11.
That concludes this edition of MacroVoices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. MacroVoices is made possible by sponsorship from BigPictureTrading.com, the Internet's premier source of online education for traders. Please visit BigPictureTrading.com for more information. Please register your free account at MacroVoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the Internet each week. You'll also gain access to our free listener discussion forums and research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at MacroVoices.com if you haven't already. You can subscribe to MacroVoices on iTunes to have MacroVoices automatically delivered to your mobile device each week free of charge. You can email questions for the program to mailbag@macrovoices.com, and we'll answer your questions on the air from time to time in our mailbag segment. MacroVoices is presented for informational and entertainment purposes only. The information presented on MacroVoices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on MacroVoices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. MacroVoices, its producers, sponsors, and hosts Eric Townsend and Patrick Ceresna shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on MacroVoices. MacroVoices is made possible by sponsorship from BigPictureTrading.com and by funding from Fourth Turning Capital Management, LLC. For more information, visit MacroVoices.com.